All right, welcome to the FFL America Bootcamp. I'm sitting here with Mr. Peter Unger and Mr. Josh Lockhart, and we have the honor and privilege of talking about the amazing products and carriers that we have with Family First Life. Now, I think it's very important to know that new agents, they get hung up on what product to write, and they think that this is the most important video that they're going to watch here in bootcamp. New agents, they let product knowledge cripple them from taking action. They get what's called analysis paralysis. They think that they need to know every single product, every single brochure before they can go into a home. And I think the goal of this video here today is to break down simply the carriers that we write and the products that we write with them. And you don't have to learn every single product. The most important thing to know, Matt Smith, he has really pioneered this concept that 85% of what we do is the phones, 10% of what we do is the in-home, and 5% is the product knowledge. So today we're going to be talking about that 5%, and just know that it's just the 5%, and we hope that we can really ease some of your worries in knowing that you don't need to know absolutely everything here about the products, because you're going to learn them as you go. We talk about getting to your first 100 appointments as quickly as possible, and we're going to talk about how to leverage your manager, leverage some of the tools like our underwriting genie to be able to know what products to write. But in this video, we're really going to dig into what products that we have, how they work, some of the details, and you learn them as you go. Grady talks about how you learn in two different ways. You learn from repetition, or you learn from emotional impact. So you go and you sit in 100 homes over and over and over again. You're going to see pretty much every scenario that you could possibly see, and there's not really many directions that you wouldn't know what to do after you sit on 100 appointments. Or emotional impact. You go and you sit down with a client who has their 63, non-smoker, taking metformin and a high blood pressure medication, and you call your manager and they say you're going to write an America Eagle policy, and you sell it for $2,400. You have a fantastic emotional response because you just got that sale, and now next time I sit down with somebody who's diabetic with high blood pressure, I know America Eagle. So two different ways that we learn. So there's kind of two different buckets that we fall into when it comes to products. We've got term and whole life, and most of you guys probably haven't really dug into this since you were doing your licensing course. So let's start with Josh. Can you just give us just kind of the basic definitions, difference between what a whole life product is and what a term product is?
Yeah, and absolutely. And I'm glad you mentioned the prescriptions. You mentioned metformin. It was funny when I got here, I had no idea what that was. You were throwing out words when we were talking like that. I'm like, there's no way I'm going to learn all this stuff. So I'm glad we're doing this today. So, whole life, term. Those are the two main types of insurance. There's everything else that really. I don't have to worry about it, but whole life, the way I like to explain it, especially when I'm sitting down with a client, it's very simple. It's like buying a house, right? It's going to be permanent. It's rigid. It's not going to change. It's not going to go up in premium. It's not going to go down in death benefit. It builds equity called cash value, and you can get into a whole list of things why that may be important. And dollar for dollar, it is the most expensive type of insurance, but it's going to be there for the long haul. So especially on the final expense side, it's kind of the primary thing that we help our clients with. On the other side of it is term insurance. It's like paying rent. You have a 10-year lease, 20-year lease, 30-year lease, and when it's done, it's done. And typically that's used for a stopgap. My situation, I have a wife, kids, 6 and 4. And so when we first bought our term policy years ago, it was the cheapest thing. We were broke, and I just wanted the most amount of coverage just in case something happened to me. So term fit the bill for that.
Okay. Yeah, absolutely. So, Josh kind of touched on it a little bit, but whole life typically sold in a final expense scenario, but it's not the only scenario in which whole life is sold. And we'll talk a little bit about different scenarios in which we'd sell some of these products. In term, typically sold in a mortgage protection scenario or an income replacement scenario, or just want to leave some life insurance behind for somebody. Typically whole life, they have a more lenient underwriting, meaning they're willing to take more prescription medications because everything that we do, it's all based on your age and your health. So all these products, they're all state regulated, meaning that the pricing is going to be within a couple of dollars as long as the benefits are similar. If you're looking at, a dollar for dollar, putting two products next to each other that are typically the same, if there's a drastic difference in price, there's generally a drastic difference in benefits. So whole life is going to be more lenient on your underwriting, meaning you're going to get people who are a little bit older with a few more health conditions. And term is typically going to be something that you're right, it's a little bit more strict on the underwriting, somebody who has much less health issues. So typical rule of thumb, 18 to 50 term, 50 to 85 whole life, or 50 to 89 now whole life. And there are some scenarios in the middle, which we're going to talk about, specific products, specific situations in which we would write some of those different things. So I think the number one thing, fflamerica.com, the products tab. You go to the products tab, unlimited knowledge, underwriting guide, so many different places that you can go to learn about these products. I don't necessarily recommend you going and reading every single underwriting guide. You don't need to, but know that the quote tools are there, all of the links to the electronic applications. When you have all these products and all these carriers, I think it's also important as a brand new agent to make sure that you get organized. So the best way to get organized, I recommend everybody makes a Google document. In that Google document, you put all of your links and logins to every single product and carrier, your writing numbers, your username, your password, the link to the electronic application, the link to the quote tool, so that when you get into a scenario that you call your manager, which Peter and I are going to talk about here, they can tell you what direction to go and you'll be prepared. So the best part about what we do is when 5% is the product knowledge, you can leverage your manager, or you can leverage what's called our underwriting genie and help make a product recommendation for you. And I think the simplest thing that you need to know, people go, well, how does it work? What are the benefits? What is this and that? The number one thing you need to know as a brand new agent is it's life insurance. And if they die, it pays out. That's the simplest way that you can put what we do. Now, the difference in what product we recommend is based on their age and their health. But if they die, it pays out. That's what they're looking for. They're looking for something that if they die, a lump sum of money is going to go to their family. So you call your manager for a product recommendation, you fill out your financial inventory, or you go into the underwriting genie and they will make a recommendation for you by simply putting their age, their gender, the medications they're taking, the conditions that they have, and they'll make a recommendation for you. Now, before we had the underwriting genie, it was traditionally call a manager, and I still believe deeply in calling your manager in your first 15 to 20 homes, because you're not just getting a product recommendation, you're getting a quarterback in your ear that's going to coach you on what to do next. So, Peter, I mean, if you could just kind of talk about, I know this is something that you were so good at as a brand new agent, calling me in the home and just leveraging, I'm calling my senior underwriter. So if you had a brand new agent right now, how would you kind of train them on how to call you in the home for a product recommendation?
The first thing is, you get in a home, you sit down, you set the table, you go through the financial inventory. Don't call until the financial inventory is completely filled out. And a lot of times what we'll ask is, send at least the first few homes you're in, just send a picture of it right before you call. That way we can see what you're dealing with, because you might not know how to go through it in the best order.
Or how to pronounce the medications. So rather than trying to butcher your way through saying clopidogrel or some other medication like lamotrigine, just take a picture of the bottles or write down all of the prescriptions on a piece of paper and send it to your manager.
And can we add to fill out completely the financial inventory?
Yeah.
Don't skip steps.
Don't skip steps.
Right? Even the top. If they don't have a mortgage, they have rent. They have something that they're doing to pay for their housing payments. So don't skip steps on the financial inventory, because it might not all seem important to you in the beginning, but it is important to us because it tells us the client's story. And that's how being a quarterback in your ear becomes effective, is because when I used to call Jamie in the home, every single home I was in, I knew that it was important that I fill out these questions. Even if I didn't know the purpose of them, Jamie did. Jamie was now sitting in the same home with me because he understood, here's Bob and Mary's situation. Mm-hmm. So when it comes to calling in the home, make sure that the financial inventory is filled out. We've made that pretty clear. Your job is just to get in the home, get the information, and then call for help when you don't know what to do next, which is the bottom of the financial inventory. So what this looks like is I'm sitting with an older couple, and from my very first home, this is the way that I chose to go about it, and this is what I would encourage you to do. Some people like to take up the perspective of, hey, I'm brand new, it's my first day, support me, I'm a Girl Scout kind of thing. I think it makes a lot more sense to come off as a professional, because if you're sitting with someone who's 3-4 times your age, like I have many times, then I want to be taken seriously, and I don't feel like someone's going to want me to protect their family if I'm like, oh, it's my first day, I don't know what I'm doing. But either way, you have the credibility of a manager, and that's the confidence you go into the home with. And so you fill out the financial inventory and you say to them, hey, I'm about 99% sure what direction I want to go for us today based off of everything you've shared. I've got a really clear picture of what your life looks like. However, I want to give my senior underwriter a quick call for a second opinion. That way we can make sure that we really are putting your family in the best situation possible and fitting you with the best product. Is that okay with you? And it's something that our clients appreciate so much. There's never been a home that I've been in where someone hasn't been okay with that. Now, here's another thing. Never, ever unmute the phone.
Never put it on speaker, you mean?
Oh, yeah. Never put it on speaker because we're the quarterback in your ear. No one can coach you if we're also hearing the clients in the background and they're hearing us. It's really awkward, in fact. And it's even more awkward to say, hey, please take me off speaker.
Yeah, absolutely. So now let's just pretend that you're calling me right now and you're sitting down with Bob and Mary and just kind of walk through what you would say to me.
Yeah. So, hey, Jamie, I'm sitting here with Bob and Mary. Do you have a moment for a second opinion?
Yeah, I've got a moment.
Okay, great. So it looks like he's 71 years old. Mary is 73. They're both retired. They're both living off of Social Security. Bob has a pension right now. It's about $500 a month. He has about $1,500 income. She has about $2,000. They're both non-smokers. He's taking metformin for diabetes. He's taking lisinopril as well for his high blood pressure. No surgeries in the past 5 years. Mary doesn't have any surgeries either. She's taking the same medication for diabetes. Neither of them have any of the major health conditions listed below except for diabetes, no neuropathy or anything like that. Right now they have no coverage and they're renting. It's about $800 a month. And they want to make sure that if something happens to either one of them, there's no burden left behind. But I also just got done talking with them, and they also want to make sure that they can leave each other with some money if possible.
Okay. And do they want to be buried or cremated?
They both want to be buried.
They want to be buried. Okay. So we're going to start at about $10,000 for burial, and then you can work your way up just to leave some extra money behind. So you're probably going to want to show them like 10, 20, and 30 based on the medications. So Bob's got blood pressure and diabetes, Americo Eagle. Mary's just got diabetes, also Americo Eagle. Whole life. And the way that you're going to do it, you're going to write down 30, 20, 10. You're going to write out the prices and you're going to ask them to pick one. You got this.
Okay, perfect. That's exactly what I was thinking. Thank you, Jamie.
All right, bye. So I want to highlight, perfect. That's exactly what I was thinking too. So that is such a psychological thing in the home because when I call my manager in the first home, I remember when I called Grady, that's not what I was thinking. I was thinking I have no idea what I'm doing now. Hey, Bob and Mary, I'm 99% sure what direction we're going to go here, but we're just going to call my senior underwriter to get a quick second opinion. They tell you, perfect. That's exactly what I was thinking too. Awesome. Peter now has credibility as somebody who has an insurance license that's there to help. So fantastic.
And one other thing I think is important to touch on is a lot of people, they're very cold when they go through the financial inventory with their manager on the phone. Include yourself. Okay, hey, I'm sitting here with Bob and Mary. Here's what we're looking for. You can insert yourself into their life so that you're on the same side of the table with them and you guys are doing this together and you're calling to make sure that you're putting them in the best position because then you're also, creating credibility with the client. Hey, they really want to leave some extra money behind and you're telling your senior underwriter, here's what they're trying to do. And the reason why we encourage this over just using the underwriting genie is because you might get the product recommendation, but you don't get the coaching. And the coaching is almost the entirety of the call. It's the really the important part of calling in home because I could just go and get all of the answers from the Slack channel, right? From
Absolutely.
The underwriting genies.
So
go ahead.
Oh, I was going to ask you guys. So that's really great stuff. How would you handle it if somebody goes, you're asking them, what prescriptions you take, et cetera, and they go, oh, I'm really healthy, right? So how do you handle that?
So one of my biggest pet peeves is if somebody calls me in the home and they say, I'm sitting here with Bob and Mary and they're both really healthy. And I'm now the quarterback in their ear and I say, Josh, I love you, but you can never say that again in front of a client. Hey, Bob and Mary are really healthy means Bob and Mary are going to think about it because Bob and Mary are healthy and they can get approved for anything. Okay. You want to find anything on the financial inventory. So I'm sitting here with Bob and Mary. Bob's not taking any medications, but he did have a knee surgery a couple of years ago. He had some dental surgery where he was prescribed some Norco for like 3 days. So we'll see what we can do here. It's just, they're very healthy out loud.
Even family history.
Yeah.
Nothing. I've had no surgeries. I have no medications.
However, their grandmother had cancer. However, heart disease does run in the family, but they're perfectly healthy. So you just need to make sure that you're not creating a think about it situation by saying certain word tracks. So I think that's a good way to kind of set this up. We really just wanted to set the tone for knowing that if this is the case, that 5% is truly product knowledge. We're going to dig into that 5%, but you just have to know how to set the table. That's it. You walk into the home, you figure out what it is and why you're there. You walk through the financial inventory, you call your manager, and they're going to tell you what to do. You get an underwriting genie if you can't call your manager, and it's a fantastic system that we have here. So all of you at this point should have seen what's called our credibility sheet. So our credibility sheet has about 30 different insurance carriers on it. We take that into the home, we slide it in front of the client, and we say, hey, I'm a broker. These are all the different companies that we represent. So of those 30 different carriers, we're probably going to dig into maybe 6 or 8 of those carriers today and some of their most popular products, the ones that you're going to come across the most, the ones that are going to be most recommended to you in the situations in which you would sell them. So let's start off, and this is no secret whatsoever. Our favorite number one carrier, the carrier that we lead with, is a fantastic, amazing company called Americo. So Josh, you want to maybe dig in, just cover some of those bullet points, why Americo, why do we lead with Americo, who is Americo for? We'll obviously dig into whole life and term, but typically who we submit our healthiest individuals through, whether it be from a whole life or a term perspective, but what are some other reasons why we love Americo?
It's easy. It is so easy. Some of the e-apps, some of the underwriting processes can take a long time. Sometimes it feels like some of the carriers never issue policies. It's kind of a joke, but they have a prescription check, as we call it. So you kind of get a pre-check, if you will. So you kind of get an idea, hey, is this person going to qualify? So you're not spending an hour going through an application, only to get to the end to go, oh, guess not. They issue really fast. A lot of times it's in-home approval. As an agent, they pay really fast, right? So we have top comp, and on the back end, this was the first thing that I noticed. Coming from past sales, experiences and corporations, sometimes dealing with corporate offices can be very difficult. Americo is very easy to deal with, I found. So, just all around from an agent experience, it's really, really good. And they have fantastic products, right? Kind of our flagship is the Americo Eagle. That's our final expense product. And, not only does it, it's a whole life product, but something that I wasn't even aware about is the living benefits, right? And I remember calling you, and you kept saying, oh yeah, they can get over half the policy if, they have a heart attack, stroke, invasive cancer, or they can't do 2 of the 6 daily activities of daily living. I'm like, I don't even know what that, you just said those words. I don't know what that means, but that sounds good. It doubles an accident, right? So if you have a $20,000 policy that somebody has, a whole life policy, they get to an accident, they pass away, it automatically doubles. And one of my favorite things that comes up quite often is you'll one of the first questions is, are you a smoker or non-smoker? And they'll say something like, well, I'm trying to quit. And I'm like, are you seriously trying to quit? And I say, all right, great. And once we kind of go through it a little bit, I say, hey, we have this great carrier that's actually going to give you a discount, treat you as a non-smoker for 4 years. And if you stay a non-smoker, they'll continue on that rate. And, you can kind of dig into that a little bit of what happens after that. But, no other company does that. And
Absolutely.
It's such a great tool, especially sometimes, people will get, well, what about this company? Or, my mom had that company. And in that scenario, it's like, well, we have this, you're a smoker, you said you're trying to quit, whatever the case may be. We have this one carrier that will actually treat you like a non-smoker and give you a discount for 4 years.
It's a big deal because, hey, Mary, you're a smoker. If I look at any other carrier, it's going to be double the price just because of the fact that we're clicking the button.
Absolutely.
That you're a smoker.
It's almost double.
It's almost double.
Yeah.
So let's just kind of break it down. So there's 2 main products that we sell with Americo. We've got the Eagle Premier Whole Life, and then we have what's called the HMS Term. Okay, and the HMS Term has a handful of different variations. We'll dig into what each of those are, but we're just going to start off with the Americo Eagle Whole Life just because it is the most popular product we sell. Josh just touched on a lot of those benefits, but on a basic level, it starts out at age 50. It goes up to age 85, okay?
If you're a non-smoker. Age 80 if you're a smoker.
Age 80 if you're a smoker, thank you. And the coverage starts at $5,000, and it works its way up to $30,000. Josh touched on the double accidental, also triple indemnity. So that's common carrier. So if you get into a typical car accident, 20 turns into 40. If you get into a plane crash, 20 turns to 60. Common carrier, boat, taxi, plane, train, something where somebody else is driving public transportation. And then it has that smoker guarantee. So in the event that you do happen to be a smoker, you can be offered a non-smoker rate. for 4 years, and at the end of 4 years, they're going to send a mouth swab in the mail. If you test negative for nicotine, they'll let you keep your non-smoker rate. If you do test positive for nicotine, they're either going to adjust the face amount or the premium to whatever that new smoker rate is going to be. So the American Eagle is typically who we submit our healthiest whole life clients to, who are looking for final expense. This is going to be someone who's looking for burial, for cremation. There's so many scenarios in which we use the American Eagle product. We're not going to dig into every scenario that we do, but it does have that underwriting check. So you're going through the Americo application, Peter, so you're going through the financial inventory, and now you say, okay, so we're just going to do a quick prescription check because your manager says, hey, Peter, Americo Eagle all day. But obviously, you're going off the medications that they shared with you. So I always like to follow up with the question, is there anything else you've taken in the past that you've stopped taking or chosen not to take? Because sometimes clients lie to you. The Americo prescription check, it makes them truthful. We can figure out what it is that they're taking. So now you go, okay, we're going to run a quick prescription check to find out what it is that you may qualify for. You go through, you run the prescription check, and then a little box pops up that says, the insured may qualify for up to $30,000 level death benefit, or it pops up and says the insured does not qualify for the level death benefit. They only qualify for the $10,000 guaranteed issue whole life. And if that notification pops up for you at any point, exit out of the application, withdraw the application. We don't sell that product. We have better guaranteed issue products, better commission opportunities for that, put a client in a much better position. So we only sell the Eagle Premier whole life. We do not sell the guaranteed issue whole life with Americo. So the Americo Eagle, absolutely fantastic product. Let's dig into term. So HMS, Home Mortgage Series. Even though it says HMS on it, you don't have to sell it. It doesn't have to be attached to a home. But the most popular reason that this product was created was for mortgage protection. So, Josh, can you just explain, what mortgage protection is real quick?
Yeah, it's actually, I'll say first, it's not as fancy and complicated as it sounds. Yeah. As soon as we hear mortgage protection, people think all kinds of things. It's just a product designed to, fit the needs of a mortgage. Usually it's, 100, 200, 300,000, et cetera, et cetera. But anyway, yeah, so it's a term product. We have, 10, 15, 20, 30 year. Mm-hmm. Is there a 25 year?
There is, yep.
25-year options, and starts at $25,000, goes up to technically $400,000. It's important to note at the $250,000 level and above, it requires a mouth swab, which I found out the hard way. I was in a home, I wrote a $400,000, and it said it had additional requirements. I didn't know why, so I had to go back and jump through some hoops. So just know if you're going above $250,000, that's going to be the case.
You got to get saliva educated. You've got to buy swabs. The swabs have to be brand new. You have to actually go to their house and swab the inside of their mouth.
It's a lot of work. Yeah, I did the swab for our CBO policies. Like a lot of times we recommend that you max out simplified issue coverage with a carrier for term, and then you can pivot to another carrier to get them additional coverage. In a lot of situations, when you agree, it's better to get $250,000 term coverage through Americo and then pivot over to Mutual of Omaha for whatever's left.
Oh, absolutely. Just doing the swab, it's a pain in the butt, fully underwritten. We're going to talk a little bit about that here shortly. We want to avoid that at all costs unless the client really needs it, and we'll talk about the situations in which they need it. Simplified issue insurance means we check their prescription history, and generally the policy is approved within 24 hours or even in the home. And there's no super long-term underwriting. There's no medical exams, no blood, no urine, no anything like that. So $25,000 to $250,000 simplified issue, $250,000 to $400,000 with a mouth swab. And if you do happen to be what's called a You First qualifier, which we'll talk about the 8% bonus here in a second, you can write $300,000 without a mouth swab. Okay, which is fantastic. So the Americo term, there's a couple different variations of it. Okay, so you have a term 100, a term 125, a CBO 50, and a CBO 100. Now, that sounds like gibberish to most people, but it's actually quite simple. So we'll start actually at the term 100. So a term 100 is a very, very basic term insurance product that lasts for either 15, 20, 25, or 30 years. Same amounts of coverage that we just talked about. It goes from ages 20 to 75. Okay, so this is actually the number one product that we have in terms of the highest age that you can go to for term insurance, but they do obviously have to be healthy enough to make it through. So not a crazy amount of medications. Just in general, every single one of the term products, they obviously pay out if you pass away within 15, 20, 25, or 30 years. If you become, Josh talked about living benefits with the term specifically. So chronic, critical, and terminal illness. So chronic illness, there's 6 daily living activities: feeding yourself, bathing yourself, clothing yourself, toileting, transferring, medicating. Okay, so there's 6 daily living activities. I got into a skiing accident a couple of years ago. My wife had to help me, sit down on the toilet, put my socks on, get in and out of the shower, transfer from, the bed to the couch, she'd bring me food, the whole deal. If I had this Americo product, which I do have now, and she was having to help me with those daily living activities for over 60 days with a doctor's note, I could have actually withdrawn money out of my policy. So if I had $250,000 and I got into a car accident that did not result in death, but I needed assistance with 2 of those 6 daily living activities, I could have what's called an accelerated death benefit, and I could actually withdraw up to 100% of the money out of that policy. So the living benefits are fantastic. When it comes to chronic illness, critical illness, I believe there's 13 qualifying critical illnesses, most common: heart attack, stroke, cancer. There's a handful of others you can check out in the pamphlet. And then terminal illness. If you're told you have 24 months to live or 12 months to live, they're going to give you a 100% accelerated death benefit. So you're covered if you pass away. You're covered if you become sick or disabled. Okay, so hopefully that makes sense. And that's applicable to all of the term products that we're about to go through here. So basic level, term 100, it just means that it's a straight term with 100% death benefit. The term 125 means that it's the exact same product as the 100, but if it happens to be an accident, let's say Peter has a $100,000 term 125 and he passes away in an accident, instead of $100,000 paying out, $125,000 is going to pay out. But if he has a term 100 and he passes away in an accident, just that $100,000 is going to pay out. So, of course, the term 125 is going to be just a tiny bit more expensive than the term 100 because it has some additional accidental. Does that make sense? Okay. And then our most popular product is the Americo cashback option. So, Peter, can you kind of explain, what is a cashback option? What's a return of premium? There's 20 and 30 years. It's still straight. It's a term product that's going to last for a certain period of time. But what do they mean by cashback option, and how can the companies actually afford to give their money back?
So most term products, the way that they work is they're either decreasing, meaning that the term death benefit is going to go down over time, or it's just level. And so just like the term 100 and the term 125, it's going to stay the same. With the CBO 50 and 100, you have an opportunity to get back all of, with the CBO 100, or half of, with the CBO 50, the money that you put into the policy. Like Josh mentioned earlier, it's a lot like rent with term. So a lot of times you're paying into it until your term has ended. But once your term is ended, the insurance has expired and the company has made their money from your monthly premium payments. So with the CBO options, on top of having the accidental and the living benefits, on top of having a death benefit, the client is going to get back all of their money when the term has ended if they have not passed away. So it's kind of a no-brainer because it's a forced savings account. Something that we always talk about in the home is, hey, this policy, this is a forced savings account for you, and there's only 2 ways that this money is going to pay out. Either A, you're going to pass away in the next 30 years during your term length, and your family's going to get the death benefit in the form of a tax-free check. Or second, you're going to outlive this policy, and when you blow out the candles at 69, when you have had this policy for 30 years, you're going to get back that $74,000 you paid into it over the last 30 years.
Yeah, and it's just simple math, guys. So if I have a policy that's $83 a month, that's $1,000 a year in annual premium. Multiply that out for 30 years, I paid in $30,000. People go, well, if you paid in $30,000, they're going to give you back $30,000. How does the insurance company afford to do that? I think it's important to note that 98% of straight term policies don't pay out, and that's because people outlive them. So that's why there's so much value to a cashback option. Then also you have to understand that Americo, Mutual of Omaha, all the companies we're going to talk about, they are financial institutions. They are smarter than us, and they are trading every dollar in the market actively as they are insuring these clients. So you have to imagine that if I'm a savvy financial institution, I can make more than $30,000 on your $30,000 over 30 years.
Absolutely.
And I can afford to give you all your money back because you basically took out insurance on your insurance. So the difference between a cashback option and a term 100 or 125 is it's probably about 20 to 30% more expensive. And that 20 to 30% that you're paying for the premium is going to guarantee that you get a return on your money. So when I sit down with Bob and Mary, well, guys, if you die, you're covered. If you become sick or disabled, you're covered. And if you live, you're covered. Does that make sense?
Yeah, I really like what we were talking yesterday, and you said on the CBO specifically how you position it. You say, hey, I'm really great at paying my bills, but I'm not so great at saving money. So this is a great way to accomplish that. And from a quoting, this is something that kind of confused me. I didn't understand it. I understand why it worked this way. But typically, if you have a 10-year term, 20-year term, 30-year term, they're going to be expensive the longer you go. Well, with CBO, it's the exact opposite, right? The longer that you go, the cheaper it is. So that's just important to know, if you're quoting that, you're going through that is right. It's not a mistake. But also, like Jamie just said, the longer they hold on to the money, the more they get to make, so, they can give that back. So if you see that, you're confused, it's supposed to be that way.
Absolutely. So no cashback option. Rule of thumb is the longer you're covered, the more expensive it is. With a cashback option, the sooner you want your money back, the more expensive it is. So if I have a cashback option 15 year, in 15 years, they're going to pay me back on my premiums, it's going to be more expensive because I want my money back sooner versus just a straight term with no cashback. They're going to insure me now longer. So that's kind of the differentiating factor there.
It's also a no-brainer policy, right? Because it's like, you can't go to your bank and say, hey, I just lost my spouse. Can you guys give me $200,000 because I've been saving $100 with you each month? They're going to laugh at you. But that's exactly what you do with a CBO policy.
Yeah, I mean, it's a forced savings account with a giant life insurance policy on top. So that's the product that I personally have. It's a fantastic starter product for anybody who is young and decently healthy. Fantastic starter product. There's more advanced products you can get for yourself as you start to learn this industry, but it's a fantastic product to start with. So last thing we'll touch on before we move on to the next carrier is, so obviously we want to put the client in the best position. We talked about clients first, agent second, and then it can't hurt the company. Well, if we're going to put agent second, there's an 8% bonus that is paid out by Americo, which is a fantastic reason why we love Americo. So there's something called the You First program that typically goes from the first week of January to sometime in July, and then July to the last week of November. Typically pays out one bonus in the summer and one bonus right around Christmas. If you write $45,000 in annual premium within a 6 months period, you're going to get an 8% bonus on top of the comp that you're already getting. So 8% of $4,500 is $3,500. So the minimum You First bonus is $3,500. We have agents who their You First bonus is over $10,000 every 6 months. So they're earning an additional $20,000 a year just by putting Americo first. And it's just 100% based on, we lead with Americo. Because it's who we put our healthiest individuals through. And if you have a scenario where somebody maybe is a little bit less healthy, we can talk about some different scenarios that we might go about. So we love Americo.
Absolutely.
Americo first. And we have a lot of other fantastic companies that we're going to go ahead and dig into here. So hopefully that all makes sense for you guys. Second company, somebody that, they're the largest public insurance company to exist. So Americo is the largest private insurance company to exist. A lot of companies say, well, I'm looking at your credibility sheet and I've never heard of Americo. Okay, well, Americo's the largest private insurance company in the world. They don't do commercials. Lamborghini doesn't do commercials either. Yeah. They're a fantastic company that's been around for over 100 years. Mutual of Omaha. A lot of people have heard of Mutual of Omaha. This is a household name. This is, they used to do TV shows back in the day. They used to sponsor football games back in, the early years. So they've been around for a long time. Everyone knows their logo. And they have a handful of different products. So just like Americo, they have a whole life product and they have a term product. They also have a fantastic accidental product and some advanced products. So we're going to dig into each of these as we go here. So we'll start whole life again, just to kind of keep the theme. So Mutual of Omaha, Living Promise Whole Life. Okay. So it goes from $2,000 up to $40,000. Okay, so you can actually, minimum death benefit on Americo is $5,000. Minimum death benefit with Living Promise is $2,000. Maximum death benefit with Americo is $30,000. Maximum death benefit with Living Promise is $40,000. It actually goes from ages 45 to 80. Yes. Okay, 45 to 80. So if you have somebody that is 45, they can't qualify for an Americo Eagle product if they're looking for whole life. So that's a fantastic product. And we've got another one that even goes down to 40. Very similar benefits. You can add on accidental. So Americo has a double accidental included. The Living Promise, you have to click a little box, and that little box will increase the premium by giving them the double accidental. And they have a level and a graded option. So Americo has your Eagle Premier, or we don't go guaranteed issue. This has a level and a graded. So it has two different levels of coverage. Josh, could you kind of talk about like how, because we're going to talk about a few different carriers that have like a rating system.
Right.
What does that mean? Level, graded, all that stuff.
Yeah, so depending on the carrier, level is immediate coverage. So if you have a $20,000 policy, it's going to stay a $20,000 policy. Different carriers, may call it something different. They have like a lower tier. It could be return of premium. It could be modified. It could be graded. Return of premium, not to be confused with what we just talked about on the term side, CBO, cashback, that type of thing. So in some cases, it could mean in the first 2 years, if you pass away, you're going to get all your premium back plus 10%. Generally, some of them have kind of a stair step kind of option, right?
Most of our carriers, if they have 3 options, the graded option is typically like you'll get 30% back of your death benefit if you pass away within a certain amount of time, and then from there it goes to 70. It's usually 30% on the first year, 70% on the second year, and then the full death benefit on the third year.
Yeah.
For that mid level for graded.
Yep. So Living Promise has a level and a graded. So they have an immediate coverage, and then they have a graded option. Very similar death benefit. If it's whole life, it lasts up to age 120. It's got an accidental option, and it's a fantastic product to be able to sell from a whole life perspective for final expense. Now, why would you sell the Americo Eagle over the Living Promise, Peter?
Number one thing would be living benefits. Right? Living benefits, they're going to pay a couple of dollars more, okay, to get an Americo product for the same amount of coverage. They're going to pay a couple of dollars more, and they're going to have access to the full death benefit of that product if something happens to them and they need the money, unlike typical whole life only paying out in the event of a death.
Yeah, so living benefits meaning 50% of the death benefit in the event of a terminal illness when it comes to the whole life product. So, okay, Living Promise. And then we've got our Term Life Express. So this is rivaling the HMS product. So Term Life Express, ages 18 to 70, coverage amount starting at $25,000 and working their ways up to $300,000, 10, 15, 20, and 30-year terms. They also have a 30-year ROP. Once again, not to be confused with the ROP, which we're going to talk about here in a little bit. ROP, return of premium. This is their version of the cashback option. Some of the carriers, they have similar language, but they have different definitions. So the 30-year ROP is very similar to Americo's 30-year cashback option. The Term Life Express does also have 100% living benefits, chronic, critical, and terminal illness. And then you've got Term Life Answers. So Josh, kind of talk about a scenario, what Term Life Answers is, fully underwritten, what is fully underwritten, and kind of why you'd go this direction.
Yeah, so fully underwritten, it just means that they're going to go through more of a rigorous underwriting process. Typically they're going to maybe go in and do an extra phone interview. So the company is going to have a third-party company call them, go through some additional health questions. Maybe they go in and get blood sample, urine sample, things like that. And so it is important to note that typically, if somebody goes through that, they're going to be offered better rates as long as they're healthy enough, because the company says, well, hey, if you're going to jump through all these hoops and we're going to really, really look into your medical background in depth, you can get a better rate. Now, I don't sell it for that reason, because quite frankly, a lot of our clients, they want something simple. They want something, hey, I want coverage right now. They're not interested. I had somebody the other day that said, I do not want to do fully underwriting. She just didn't want to jump through all the hoops. She didn't want all the extra stuff. But typically, the reason I would go that route is for the higher limits of insurance. A lot of the carriers, we just went through Mutual and Americo. On the term side, they're going to cap out at 300, 400. And so I have several clients who got the Term Life Answers and it was $1 million plus. I walk in the home and they're like, I want $1 million, or I want to, whatever it is, that's going to be really the best route. And what I found is those people that are asking for those, much higher limits of term insurance, they've already done some shopping. They maybe have another, fully underwritten plan they're looking at. And this Mutual of Omaha Term Life Answers option, it actually has a standard rating, and it goes up to an additional 4 levels of preferred ratings. It's so competitive in the marketplace. I've been able to do really, really good on those higher limits. And these are savvy people. They kind of know what's going on and they know what they want.
And when we say higher limits, it starts at 100,000 and it goes up to 65 million.
Right.
Okay, so I'm wondering what are you trying to protect with $65 million worth of insurance? I mean, someone who's wealthy, estate taxes, there's a lot of different reasons why somebody would go ahead and do that. Okay, so we talked about Living Promise, Term Life Express, and Term Life Answers, the three main products that you're really going to lead with when it comes to Mutual of Omaha. Now we're going to talk about some supplemental products and advanced products, okay? So supplemental products, add-ons or downsells, okay? So probably one of the biggest add-on products for myself, and this is probably, so this year I'll probably write close to $500,000 in premium, and I would say over $100,000 of it is accidental death insurance, okay, which is crazy. So accidental death insurance, ages 18 to 70, no underwriting, okay, no underwriting. So that means as long as you're 18 to 70, you could have anything going on with you in the world. You could have felonies, DUIs, you could be on death's doorstep, you could be a smoker on oxygen.
A felon.
They'll approve you. Okay.
Yeah, it's a guaranteed issue.
So accidental death insurance. So $50,000 up to $500,000 worth of insurance. Now there's a couple of different ways you can structure this. So there's individual accidental, there's individual plus spouse, individual plus children, or covering the whole family. Okay. They do have a cashback option under 50 years old in most states. Unfortunately, Josh, he lives in one of the states where the cashback option is not available. But this is probably one of my favorite products to sell from a add-on or a downsell scenario. So, Peter, what's a scenario in which you would sell accidental?
A lot of times it's with couples, right? Regardless of their age, if they're under 70 years old, I like to let people know. And this is something that you can lead with in the home is, hey, part of my job is to know the actuary tables. It's important for you to know that from now until age 65, the number one cause of death as a male or female in the U.S. is an accident, with heart disease and cancer coming behind that. From 65 to 85, though, it's really important for you to know, Jamie, that it is still the number 3 leading cause of death in the U.S. So regardless of if someone is 65 all the way to 70, this product stops at 70. You can sell them accidental from 18 to 70.
Yeah, it's a 30-year term. Okay, so it's a 30-year term, and kind of talk about, we're sitting in the home, and you're explaining accidental to me. I kind of, Grady taught me to paint the picture, so it's like, all right, Bob and Mary, with you guys not taking many medications, I think you guys could agree that the most likely cause of death, if something were to happen to you guys in the near future, it's probably going to be an accident. When you guys agree, like, we'd agree. Bob, he drives around all day long. Okay, perfect. So God forbid, Bob gets into a car accident. He slips and falls and I look down at the floor, the carpet, the tile, the wood, whatever's happening. He falls off a ladder putting up Christmas lights. He slips in the bathtub. He falls down the stairs, and you're painting the picture of an accident that could happen, and you need to make that real in their mind. And God forbid something like that happened to him. Obviously, we want to make sure the most insurance is available for whoever the survivor is. And God forbid, Bob and Mary, both of you guys, you've got kids, both of you are driving to the grocery store together or something, you get into a car accident. We want to make sure you're both covered so that your kids will be okay. So there's a scenario where, an accidental is much cheaper. And the reason it's much cheaper is because it only pays out in the event of an accident. So if there's a heart attack, stroke, cancer, natural causes, it doesn't pay out. But if it does happen to be an accident, very high levels of insurance can pay out. So individual, I'm sitting down with just Peter, hey, $500,000 accidental. Your age, it's going to be $64, okay? But now if we add on the cash back option, which it now goes to $94, okay? And $94, Peter, at the end of 30 years, if you get into an accident, between now and 30 years, $500,000 pays out to your family. But if you don't get into an accident at the end of 30 years, you're going to get back $36,000, $500. I don't know what that dollar amount is actually.
And then, by the way, how you figure out that dollar amount is just take their monthly premium, multiply it by 12, multiply it by the term length. So if with a CBO product, or specifically in this scenario, it would be by 30.
Mm-hmm. So jealous I might move states.
Oh my gosh, yeah. The return of premium product is absolutely fantastic with the accidental. So now I'm sitting down with the husband and wife. Bob, if you pass away in an accident, Mary's going to get $500,000. Mary, if you pass away in an accident, Bob, you're going to get $500,000. Bob and Mary, if you both pass away in an accident, God forbid, driving to the grocery store, your kids are going to get $1 million. Does that make sense? Yes. And if nothing happens to you, you guys are going to get back $45,000. Okay? Simple. No brainer. It's a great add-on. It's a great downsell. It's like, hey, listen, you guys don't have any insurance. You guys aren't going to do the whole life or the term because it's a little bit too expensive. Well, like we said, you guys are you don't take many medications, so most likely cause of death is going to be an accident. So what most people would do is they would at least get accidental. Does that make sense? Or, hey,
That's a key phrase. What most people.
Hey, what most people would do is they make sure that they're covered with this whole life or this term. It's going to last them up to age 70. It's going to last them up to age 120. But God forbid something happens tomorrow. We want to maximize the death benefit. So most people would add on this accidental to make sure that if you pass away in 29 years, your family's going to get $250,000 if you have a heart attack. But if you pass away tomorrow from an accident, your family's going to get $750,000 because you got the 250 here and the 500 there. You know, so it gives them a little bit more coverage.
And something I'd like to say is, like, if someone's getting $10,000 worth of whole life coverage, Eagle Premier, for each other to protect each other as a couple, you're like, hey, what we're doing right now is we're making sure that your final expenses are taken care of. But if you really want to leave a legacy behind and potential income replacement, the only way that that'll financially make sense is with some form of accident. And so then when the accidental coverage is shared, it's an option to actually be able to do a lot more than just having something is better than having nothing, right? And so one thing you can do is just have it on the paper when you show them the numbers for whatever coverage option. If it's in their budget, have the accidental there and be assumptive. Hey, so here's your options right here. Okay, cool. Let's agree. Let's figure out what makes the most sense from these three options. Okay, cool. And then what most people do in your guys' situation is they get some form of accidental. We could do 500, 400, or 300. Which of these is going to be enough for you guys?
And that's just, I love this conversation because when I was calling Jamie early on, he kept telling me, write Americo Eagle and then add on Moo Accidental. He kept saying Moo Accidental. I'm like, I don't even know what's Moo. And I didn't get it. And after about the fifth time, I got it and I started adding it on. And it was like you said, an extra $1,000 to $2,000 a week just on this, extra add-on.
It's crazy. And so we say Moo Accidental. It's called the Guaranteed Advantage Accidental Death Product in the quote tool. Okay, a lot of people do get confused by that. But I can't tell you how many scenarios where I'll walk out of a home with anywhere between $3,000 and $6,000 worth of premium because max out the wife's whole life or term policy, max out the husband's whole life or term policy, add on a spousal accidental. So now it's his $2,500 Americo Eagle, hers $2,300 Americo Eagle, spousal accidental $1,700, and now I just walked out with $6,500 in premium.
And it's one application for a couple.
Yeah, and it's one application, exactly, or a family. So we'll touch on this, and then we'll move on to the next one. Also, you can go husband, wife, plus kids. So dad and son are driving to the grocery store. Dad and son pass away. Mom gets $500K per person that was in the car, okay? Or they have a family of 7 children, any amount of people. So basically, however many people pass away in an accident, it multiply the death benefit by however many people passed away. So no one likes to think about that, but if you can add your children into your accidental policy, that's a pretty big deal, especially kids riding around with friends. Mom and dad are the main insured. Kids are added on. Kids riding around with friends, gets to an accident, $500,000 pays out to the parents. It's the worst thing in the world, but obviously, money can be left behind. So, accidental is a fantastic product. Children's whole life. We're not going to dig super deep into this one. This is a great thing to add on if you're sitting in a house with somebody who's a grandparent. You can get $50,000 worth of whole life coverage for a child for, $20, $30, $40 a month.
Up to 6 kids on one application.
Yeah, up to 6 kids on one application. It goes up to age 18 years old. They can actually continue this whole life on for their whole life. And it builds cash value. So my grandfather, he left me a children's whole life policy that I cashed out when I turned 18 and I bought my first car. It was cool. It was a junker. But, I had like $3,000 in cash value in the policy that I bought my first car with it.
My wife paid for cosmetology school with hers. Her dad bought her.
That's fantastic. Yeah. Okay, so Children's Whole Life, fantastic add-on product. Okay, now we're going to dig into one of their advanced products, and we're going to kind of move quickly through the rest of these carriers. So there's an advanced product that is simplified issue through Mutual of Omaha. It's called the Indexed Universal Life Express. So Josh, if you could just give us kind of spark notes on what is the IULE and what scenario that would really come up in.
Yeah, Indexed Universal Life. So we talked about it earlier, there's whole life, there's term, and then this thing in the middle called Indexed Universal Life. So it's, typically much cheaper than a whole life. Most often, it's a bit more expensive than a straight term product, not the CBO products. And so it's kind of a really good middle ground. It's very flexible. We won't jump into all the bells and whistles. And the index just means it follows along the S&P 500. It's not an investment. We don't call it an investment. However, if the market goes up, it can, do very well, 5, 6, 7, 8% that the cash value grows. If the market goes down, it's not going to lose money. So that's really great. And really the scenarios that come up is anyone 60 to 70, maybe they're looking for mortgage protection, 100,000, something like that. Everything becomes very, very expensive. The CBO products, especially with Americo, end at 60 through pretty much all the carriers, I believe. So there's not a lot of great options for them to have a higher amount of insurance, especially with cash value, especially when you get to that 65 age. Some of the term products become very comparable in price to the Index Universal Life Express. And so, if you're looking at maybe a 68-year-old, a 15-year, $100,000 term, they're healthy and especially if they're a non-smoker, that IULE is going to be super comparable, in some cases even cheaper. So it's not even something that you have to learn and sell and go, okay, hey, I got to know all these bells and whistles. It's like, hey, Bob and Mary, we can either do a straight 15-year term. When it's done, or I have this other thing that it's about the same price, it's about the same coverage, except for it does build cash value. So you have some options to do some things there, extend the life of the policy. It can be more of a permanent solution. It has the living benefits. And it's about the same price. And they're 100% of the time, they're like, well, yeah, why wouldn't I do that? And so that 60 to 70 crowd, sometimes if they're very healthy and a non-smoker, the 55 to 60 crowd. And then the only other scenario I would say would be, I run into sometimes, especially on the mortgage protection side, maybe somebody has a short-term mortgage, maybe like a 15-year, of course, and they're younger. That CBO 15-year, that's like the shortest term, it's going to be pretty expensive. So the IULE is a great, more cost-effective solution that is more flexible. So that's kind of the three scenarios I'd look at for that.
Definitely. I mean, and you can do an IUL for a younger person and make it more of an investment type product, but it is a little bit more complex. If you guys want to learn that type of stuff, fflams.com. Check out the AMS calls, Advanced Market Systems. But most of the time, we're just trying to get a higher whole life death benefit for somebody who is a little bit older. That $30,000 of Americo Eagle or $40,000 of Mutual of Omaha is not enough. And when we stack the different whole life coverage together, meaning, okay, I'm going to get you an Eagle, I'm going to get you a Living Promise, I'm also going to stack, AmAm and Aetna and Prosperity on top to be able to get you to $150,000. And for $150,000 a straight whole life, it's going to be $1,400 a month. Right. But then that $150,000 through an IUL ends up being like $400 or $500 a month. So it's a pretty big difference. So
just keep in mind that it is term underwriting guidelines too. Yeah, so it is stricter underwriting.
Yep. So it's a whole life product with term underwriting guidelines. So if they can get approved with an Americo product for term or a Mutual of Omaha product for term, based on the underwriting guides, based on your financial inventory, then they could probably get approved for IULE. And it's simplified issue, meaning that it's going to get approved just like any of these other products pretty immediately within 24, 48 hours.
And just, quick limit note, right? So it's 25,000 it starts at. Mm-hmm. So, I mean, if you're looking for somebody for 10 or 15,000, it's going to be more expensive because it starts at 25. Yeah. Goes up to 300,000. From 50 to 60, it kind of tiers down. The max is, I think, 250. And then from 60 to 70, it is 150,000. And it ends at 70.
Yep. So 18 to 70, 25,000 up to 300,000. Fantastic products. So that's Mutual of Omaha. Now we're going to start digging into. So we just talked about a lot of products that are typically for our healthiest individuals. Americo and Mutual of Omaha are our lead companies for our healthiest individuals. Of course, they take different scenarios, but we're going to dig into some companies that they take some of our more.
Mid-tier healthy.
Mid-tier healthy. That's a PC way of putting it. Okay, so one of my favorite companies, American Amicable. Okay, and one of my reasons that they're one of my favorite companies is they're a small company. Okay, they're a small company that they take your comments, especially in the agent remarks section of the application. They take it to heart when making a decision. So I'm sitting there and, hey, this person had these health conditions in the past, but they've turned their life around and they're doing X, Y, Z and they're not on this medication anymore. They read that stuff. Whereas some of the other carriers, they look at prescription history and they just say, oh, that medication's in there, they're out. Yep. They're denied. So I love American Amicable for that. Once again, very simple. They have a whole life product and a term product. So whole life, the Senior Choice Whole Life, ages 50 to 85. Now, Josh had started talking a little bit earlier about the different tiers of coverage. So you have immediate coverage, we have graded coverage, and we have ROP coverage, which once again is not to be confused with the cashback option. So the immediate coverage, $5,000 to $30,000. It's going to go from ages 50 to 85. Immediate coverage, meaning if they pass away tomorrow, it's going to pay out. The immediate coverage with American Amicable is comparable to somebody who would get approved for an American Eagle or a Living Promise. The healthiest individuals for American Amicable are going to get approved for immediate coverage. Graded coverage, $5,000 to $20,000, and ROP coverage, $5,000 to $20,000. Now, there's a couple of different reasons why something might go graded. We have these awesome underwriting guides. So if you're somebody who when you're brand new, you're just going to be just calling your manager and they're going to tell you what to do. And you might not know why they're telling you what to do. They're going to say, hey, go AMM graded. They're going to say, hey, go AMM ROP. And you're not going to know why. But if you go to the FFLamerica.com, you go to the products section, you click on the final expense cheat sheet. There is like a gridded system with alphabetical order, every single condition that somebody could have that are on the insurance applications. And you go there and it says, I'm sitting here with Mary who had heart surgery 4 years ago, and you go down to H, heart surgery, and it says if, heart surgery was outside of 3 years, then you can go graded coverage. If it was inside of 3 years, you have to go ROP coverage. And it's all based on the questions on the application. So it's important. There's two things that are determining what direction we're going to go with products. It's based on the medications they take and the questions on the applications. Questions they're asking are, have they ever had a heart attack, a stroke, cancer, diabetes, high blood pressure, rheumatoid arthritis, lupus, asthma, COPD, anxiety, depression, kidney or liver disease?
Yeah, and I like, AMM and our next carrier, when you're walking through the application, they kind of guide you. It's like if you answer yes to these, it could be immediate. If you answer yes to these, it could be graded. If you answer this, so it is pretty simple. That's why I like them.
Yeah, and if you ever have somebody, this is my little trick here. If you ever have somebody who's taking a blood thinner, okay, and I just recommend when you write down their medications, you Google the medication and find out what it's for. Yeah. And if when you Google the medication, it says blood thinner, American Amicable Senior Choice return of premium it's a lock. Okay, as long as they don't have some other things that might disqualify them. A lot of the other carriers, they're not fans of blood thinners. Blood thinners are big deals. So blood thinner, you've had a stroke, you've had bypass surgery, you've had some sort of thing that requires them to thin your blood. That's a big deal. It's for people who are, pretty unhealthy. They've dealt with something that's very serious.
It's a red flag medication for most carriers.
It's a red flag. So American Eagle, decline. Living Promise, decline. Immediate coverage with most of the carriers, decline. But the goal is we're trying to get people immediate coverage. The alternative is you go guaranteed issue. But this is an option where it'll go return of premium. So return of premium with American Amicable, if you pass away in the first 2 years, 110% of the premiums that you paid in are going to come back to you in the form of a return of premium. And if you pass away at 2 years, 1 day and beyond, the full death benefit's going to pay out. So if I pay in, $2,000 and it's within the first 2 years, I'm going to get back $2,200. That's 110% of what I paid in. And if my death benefit was $20,000 and I make it outside of the 2 years, the $20,000 is going to pay out to my family. Does that make sense?
Yeah.
Okay, perfect. So the Senior Choice Whole Life, fantastic product, comparable to any of the other whole life products we've talked to, but they're a little bit more lenient on their underwriting, and they give availability to some people who've had heart medications. And that typically I go to AMM, graded, or ROP when somebody's had things that go on with their heart specifically. So if you think heart, think AMM.
Yeah, and when we just don't know. When we run the prescription check for America, we sit there, it comes back, we can't go Eagle, and we don't know what the problem is. We're talking with them through their medication history.
And they don't know either.
Well, a lot of the carriers, because of their underwriting systems, for lack of a better terms, they will assume the worst. If they see a medication typically prescribed for COPD or for seizures, they will assume that you have COPD and seizures, where AMM will get to the end of the application and say, hey, is the proposed insured taking XYZ medication for COPD and for seizures? And if you can answer no honestly and then leave a remark, you're probably going to get that client approved as long as it matches up with their medical record.
Yeah, it'll jump into underwriting, and maybe it takes a day or two more, but at least at that point they take those comments into account. And if there's a medication that you just can't, what medication is getting them declined? You run AmAm Senior Choice, and at the end, it literally pops up. These 4 medications are popping up as red flags on our system. Ask them these questions. Yes, no, yes, no. Okay, perfect. You say yes, they're probably going to decline. You say no, then they give you a chance to basically defend the client and give a chance to get them approved. So fantastic product. The American Amicable Easy Term, next product. So Easy Term, ages 18 to 70. You've got $25,000 to $300,000 in coverage. You've got a 10, 20, and a 30-year term, and you've got a 20-year and a 30-year ROP. Now, once again, not to be confused with the ROP that we just talked about for whole life, which is the 110% return of premium in the first 2 years. This is a return of premium if you outlive the term. Right. Basically a cashback option. They just happen to use similar language. So a 20 and 30-year ROP. And we're not going to spend a lot of time on this one, but let's just say that it's the most lenient term of all of the terms. So if you can't get them approved with Americo for term, you can't get them approved with Moo, you maybe didn't get them with John Hancock, and you had one last final Hail Mary. I'm going AmAm Easy Term.
For sure.
Okay, so let's keep going. Next carrier is quickly becoming one of Family First Life's favorite carriers is Aetna.
Yes.
Okay, so Aetna is owned by CVS. So household name, once again, everybody knows Aetna. Everybody knows CVS.
It's over 100 years old.
Yeah, over 100 years old. And they have the widest range of age of any whole life product on the market. So we talked about how Americo starts at 50 and goes to 85. We talked about how Mutual of Omaha starts at 45 and goes to age 80. Well, Aetna will start at age 40 and go to age 89.
That's big. That's big.
It's the oldest we can insure a client here.
Yeah, it's the oldest we can insure a client. A lot of carriers stop at 80. Americo, we're pretty lucky, goes to age 85, and that's a big deal. But getting up to age 89, and some of the premiums are pretty large, but there are some clients out there that they know they want and they need the insurance. And I mean, an 89-year-old who wants $30,000 worth of insurance, they're going to have a $700 a month premium. And if they really need it and they got it, I mean, that's a nice payday. 5,000 up to 35,000. Depending on the level of coverage. So they have preferred, standard, and modified. I love this preferred rating, okay? Preferred rating, especially if you got a price shopper and they're super healthy, this is pretty much going to beat any whole life price on the market. Their preferred rating is absolutely fantastic. Standard, and then modified. Modified, very similar to the ROP we just talked about, 2-year waiting period, 110% return of premium. Reasons why you might go Aetna. Okay, reasons why you might go Aetna, they're 40 to 89. So you got somebody who's in the younger range that wants whole life, or you got someone in the older range that wants to go whole life. You have somebody with COPD. Okay, if you hear COPD, think Aetna. Okay, COPD, think Aetna, because when typically somebody has COPD, they get put into a graded or a modified situation that gives them coverage with a waiting period. Our goal is always to try to get someone immediate coverage if it's possible. So I could technically go COPD, AmAm, and they're going to go ROP with a 2-year waiting period, and they definitely will get approved. But if they die in the first 2 years, their family doesn't get much. Whereas if I do my research and I go to the right carrier, I go to Aetna, I take someone with COPD, and if they pass away tomorrow, their family gets paid out the full death benefit tomorrow, which is absolutely fantastic. So if you hear COPD, think Aetna. Okay, and it also has no build chart. Okay, so if you're sitting down with some of our how do you PC say this? Some of our heavier individuals,
they're too short for their weight.
They're too short for their weight. Thank you. Okay, there's no build chart. All of the other carriers have a build chart. If you're 5 foot, the max amount of weight is this. If you're 6 foot, the max amount of weight is this. Or there's even a minimum weight, believe it or not. I've sat down with someone who was like 4'7" that didn't meet the minimum weight for Americo.
Or the minimum height.
Or the minimum height. Yeah.
Yeah.
So no build chart. So if you think Aetna, think no build chart and COPD immediate.
And I will say on the younger side, I just got a 46-year-old approved preferred. She was healthy. For 50,000. So technically, it is the highest final expense whole life that we have.
Okay.
As far as that limit goes.
Absolutely, yeah. And also, it is the highest comped final expense product in the entire industry, even higher than Americo Eagle, believe it or not. So, 145% top comp for final expense, which is pretty much unheard of.
And I think it's the easiest app.
Oh, it is the easiest app.
That's why we love it.
It's got a nice electronic voice signature. Okay, and on that voice signature, especially if you're selling over the phone, think Aetna.
Yeah.
Okay, and we're going to dig through a couple of these last
Diabetic
ones.
neuropathy too.
Yeah, diabetic neuropathy.
You can go modified.
They're going to be modified. And then there are a couple carriers that are going to take diabetic neuropathy immediate, which we're actually going to talk about one here now. So Prosperity Life Group, they're quickly becoming also one of our favorite carriers. They have the New Vista Final Expense Whole Life. It goes from ages 50 to 80. The minimum amount of coverage is $1,500, and it goes up to $35,000. And it also has a level graded and modified levels of coverage based on the health conditions that they have going on. They take what's called a Direct Express MasterCard. Now, if you're here with us long enough and you run more than 15, 20 appointments, you're gonna run into somebody who is on Social Security that gets deposited onto this little green MasterCard, a Direct Express card. And most of the carriers don't take debit cards. They take routing and account numbers. And the ones who do take debit cards don't always take the Direct Express MasterCard, which has their benefits loaded onto it. But Prosperity, they take Direct Express MasterCard. So if you get a Direct Express MasterCard, think Prosperity.
Yep.
Also, they are the fastest company that we get contracted with. So you get started here. Contracting typically takes 1 to 2 weeks to get all your writing numbers back. You can get contracted with Prosperity in the first 48 hours. If you're fiending to write some business, hit up your manager and say, I need to get Prosperity as quickly as possible, and you can get out there, buy some leads, and you can get going in a matter of a couple of days from the moment you submit your contract.
Yep.
They take diabetic neuropathy level. Okay, we're not going to dig into all the what is diabetic neuropathy, tingling in the hands and feet. They're taking gabapentin or Lyrica, something along those lines. That's typically denied by most carriers or given a return of premium scenario where they have guaranteed issue whole life type of a thing. So takes diabetic neuropathy level immediate, meaning if they have it, they'll pay out the policy immediately, whereas most companies will put them into a waiting period. So Prosperity's fantastic. John Hancock, I mean, see the dude who signed the Declaration of Independence really big? John Hancock is a fantastic company that they have a straight term product. It has no living benefits. So typically if you have somebody, they go, that's just a little bit out of my budget. I still want that level of coverage. I go, okay, well, how important are the living benefits to you? The sickness, disability. They're not that important. Okay, let's look over at John Hancock here. It's going to be a straight term policy that goes $25,000 to $500,000. Okay, so it's actually got a little bit higher of a level of coverage than some of the other simplified issue term products that we have, but it has no living benefits. Couple of highlights here, 10, 15, 20, 25, 30 year, also has a 25 and a 30 year ROP cashback. There is no questions on this application about COVID-19.
Yes.
Okay, and that's a big deal because any application for term right now, the industry, it's still such an unknown, regardless of your own views on it. It's an unknown to the insurance industry that they're unbiased. The insurance industry doesn't give anything about politics. They don't give a rip about politics. They are looking at risk, and it's an unknown to them. So a lot of term carriers are denying if you've had COVID. They're denying if you have the antibodies for COVID, et cetera. And those are questions on a lot of the applications. John Hancock does not ask COVID questions.
Yep.
Bipolar schizophrenia, typically denied by most insurance carriers. Josh actually got a chance to, have one of his agents meet with the John Hancock rep at one of our conferences, and they said they actually take bipolar as long as they're working. That's a really big deal because most insurance carriers are going to not take that. They also take rheumatoid arthritis, which isn't a big deal with whole life whatsoever, but it can be a little bit more of a bigger deal when it comes to term.
Yep.
And they also take insulin diabetics, okay? Americo, Moo, AmAm, none of them will take an insulin diabetic for term. John Hancock will take an insulin diabetic for term as long as the diabetes was not diagnosed before age 30. Okay, so as long as it wasn't diagnosed before age 30, they will take it. And it has no living benefits like we talked about, just a
Age
straight
20
term.
to 60.
Yeah, and it's ages 20 to 60. Okay.
Do they still do the Apple Watch?
Oh, yeah.
Or the Fitbit thing?
Absolutely, yeah. So this is great. So the Vitality Term is the name of the product, and they do offer you a free Apple Watch or a free Fitbit. I don't know the specific details of it, but it lines up with one of their apps and basically says that if you're willing to work out and get your steps,
there's some fine print.
There's some fine print, but they give you some comparable discounts and rates if you basically are willing to commit to your fitness using that Apple Watch and Fitbit. So that's a great way to get a free Apple Watch. So that's a fantastic product.
One thing I'll say on that, and you already mentioned it, but they're outside of America. They're the only company that offers a 25-year ROP, which anybody that's really on the mortgage protection side, that's huge.
Definitely. And what Josh means by that is if somebody wants to, they have a 30-year term and they want to pay off their mortgage early, they get a 25-year ROP. They get all their money back at year 25. They use that extra return of premium to pay off their mortgage 5 years early.
Yep.
Okay. Which one of you guys wants to dig into AIG?
I'll take it. So AIG, it's really the the only company that has a true guaranteed issue. A lot of your clients, they see stuff online and they see stuff on TV. Somebody pops on and goes, "With no health questions, everybody qualifies." And so in some scenarios, they'll start to question you. Why are you asking me health questions? Well, it's guaranteed issue. I mean, it is guaranteed. We'll take everybody. Of course, is anywhere from 50 to 80. Now, so in some of the most extreme health conditions, maybe somebody just had cancer earlier this year, they have current cancer, whatever the case may be, and they're 49, nope, they have to be at least 50 years old, but they will be accepted under the condition that in the first 2 years, if they pass away, they'll get all of their premium back plus 10%. So if they paid in $1,000, right, that's going to be $1,100 after the first 2 years, you have, full benefit. Plus, I know there's some other... in the industry, I've seen some other guaranteed issue products. They're really, really price competitive. They go down to, I believe it's $1,000, and their max is $25,000. Now, in this situation, this is something I kind of found out the hard way. I had somebody that was on, they were like in that low side of the 50. They're like, well, can I get two of them? No, you can only get up to $25,000. And this is really the same for all the whole life carriers, up to their max. I think it's per calendar year, per 12 months, I believe.
Yes.
Yeah.
You can resubmit with any of our carriers. You can have up to the maximum amount of coverage that we're talking about today. So if Americo is $30,000, then you could have a $15,000, a $10,000, and a $5,000 policy through them. But each time you'll be reevaluated on a health level before they qualify you and approve you for the additional coverage. So you can have up to $30,000 with AIG. It's up to 25.
Yeah. And so I just said that they're really priced competitively for the product, but I mean they're going to be more expensive than any kind of immediate coverage because they accept everybody. If we accept everybody, that means we have maybe some healthy people bought it for whatever reason, and the sickest of sick people bought it, and so the premiums are going to be a little bit higher. But in the event of an accident, it does pay out, which that's pretty fantastic.
So some situations where we would go AIG would be active cancer, kidney dialysis, oxygen, oxygen, HIV. Okay, those are some big ones.
Had a stroke this year. Yeah, yep. So big. If you look at the health conditions and if you circle, heart attack, stroke, cancer, kidney, liver disease, etc. You tell your manager, they're going to ask you when it happened, and if it happened recently, you're probably going AIG, guaranteed issue. And
it's our last resort.
It definitely, but they're a fantastic company. They've also been around for over 100 years, and their formal name is actually American General Life, AIG for short. AIG is their logo. And then lastly, another fantastic company that's been around for over 100 years. You're not going to really write them too much, but Transamerica. And there are some unique scenarios where you might write Transamerica. The Transamerica solution, immediate solution, final expense, whole life. It goes from ages, I don't know if this is right, it says 0 to 85.
Yeah, it goes low. Yeah,
okay, it goes low. So whole life from 0 to 85. So I guess you could write your kids on this. And then also it starts at $1,000. And it goes up to $50,000. Now, the max amount of coverage is definitely based on your age. So if you get into some of the senior markets, the max amount of coverage is going to be $20,000 or $30,000 again. But in some of those lower tiers, you're going to be able to get up to $50,000. Transamerica also takes COPD immediate, which is important to know. And they take Direct Express MasterCards. So there's a couple scenarios in which I would use Transamerica. So Prosperity starts at age 50. So if I have somebody who has a Direct Express MasterCard with Prosperity, they're going to get, but then they have COPD. Prosperity doesn't take COPD immediate. Prosperity takes COPD modified. But Transamerica takes COPD immediate and they take Direct Express MasterCard. So it's like there's these combinations of different knockout things that would knock somebody out of getting immediate coverage. Our goal is to always get somebody immediate coverage. So there's very rare scenarios. Now also, somebody's under 40 years old that has a Direct Express MasterCard. You get that when somebody is on what's called SSD, Social Security Disability. So you have SSI, which is for retirement, and SSD, which is for disability. when they're 40 years old and they are on disability, all the term carriers don't take Direct Express MasterCard. So what is your option? Just to get them no insurance? No, you don't. Right. You're going to help the family. So we help the family by going over to Transamerica in this scenario, under 40 years old with the Direct Express MasterCard, take COPD immediate, and they're a fantastic company as well.
So we've got 3 that will take Direct Express, right? We have Prosperity, AIG, and Transamerica.
Oh yeah, AIG also takes it as well. Mm-hmm. So yeah, Prosperity, AIG, Transamerica. So just remember PAT. I think that Mike says that in our group, Mike Curry, in our groups all the time. If you think Direct Express, think PAT, Prosperity, AIG, Transamerica. Okay, so those are our main carriers. You've heard that we have about 30 different carriers that we can get contracted with. Specialty products versus our main products. We're not going to dig into those specialty products here today. Now, this is a lot of information. This is a long video. This is over an hour long. You guys tuned in. You took notes. Just important to note that, remember, 80% is the phones, 10% is the in-home, and 5% is the product knowledge. You have this. Refer back to this. Take notes, but lean on your manager. Lean on the underwriting genie, and know that product knowledge is learned through doing it over and over and over again. Guys, I did not even call a carrier to ask for a product brochure for my first 9 months in the business. I just learned through doing. I learned through checking the cheat sheets. I learned by plugging in, doing it over and over and over again. So do you guys have any final thoughts here on just making it so like a new person just doesn't find themselves overwhelmed trying to figure out, how do I know all the products?
Yeah, just echoing what you said. I mean, I remember there was a specific case I was in a home I called you about, and you made a product recommendation. It was kind of off the beaten path of the normal stuff. And I called you afterwards, and I was like, wow, how did you know that? Where did you go to find that? And you said, it was like, 2 months prior, you had a guy that you sat with, and you just remember his case because you had to look into it. And because you were there, you now remembered it could help me. And so I just took that as, well, yeah, I mean, we just did this hour-long thing, and it's fantastic, and I hope you got some takeaways from it. But you're not going to sit here and learn all the underwriting stuff. It's impossible. But when you get in the real world scenarios where you have to solve it with your manager and they tell you what to do, and you put a face and a commission with that person, you'll remember it.
Absolutely.
Repetition or emotional impact. Josh had an emotional impact, or I had an emotional impact, and I imparted it onto Josh.
Yep.
Yeah, absolutely. And just keep in mind, I think a lot of people want to know the products because they want to answer all the questions in home that the client's going to ask about the product that they're actually never going to ask. They're not going to quiz you on CBO 100. They're not going to quiz you on Americo Eagle's extra benefits and riders that are added into the policy by default. So if you're worried about going into the home, not knowing enough about the products because of the questions that the client is going to ask, our job is to lead, guide, and direct. We are going to tell them what product we're going to go with, and we're going to give them the amounts. Leave that to your manager. If your manager is doing things the way they're supposed to, which all of us are trained pretty much the same way here, then they're going to give you the product to write. They're going to remind you of the benefits if you're brand new. That way you can regurgitate it. Your only job is to get in, fill out the financial inventory, get the information on paper, get that product recommendation, and more than anything, the purpose of that phone call is to get the coaching, because that's really where there's a million different ways to do this thing. There's a million different ways to close out an appointment. It's going to be based off of what advice your manager gives you, and that's how you'll know, how to move forward. That's a lot more important than knowing the products. We need to know how to protect people the best to our ability, and we can't be good underwriters when we're brand new. We might be giving someone, graded coverage when they actually deserved immediate if we're just guessing it ourselves. So that's an irresponsible decision. The right thing to do, and the best way to close in the home is to call someone else and let them give a professional opinion.
So guys, don't get hung up on this. Don't think that this is the most important thing. The most important thing is buying leads, dialing the phone, getting the experience of sitting in the home. Do not let this cripple you from taking action. Do not get analysis paralysis. Get out there and run 100 appointments, and I promise you that you'll have product knowledge, just like we've been able to talk about here today. So thank you guys so much for watching, and we're excited to see you go out there and sit with your first 100 clients. Let us know how it goes.